AI demand looks real to us, but its skyrocketing growth will decelerate eventually. When it does, investors will likely stop pricing AI as one trade. Ed, I am so glad to say joins us this morning. Ed, great to see you. So let's start there. Sure. This is something that we were struggling with a little bit with Nikolai Tengen in the last hour, where on one hand, he's bullish AI and seeing a lot of productivity gains. Sure. On the other hand, he's saying this is as good as it gets when it comes to market returns. Do you feel the same way?
No, I think the market's going higher, and I think it's going higher on earnings. As a matter of fact, I felt the need to coin a new acronym, which is FEMO, Fabulous Earnings Momentum. We all know about FOMO, which is kind of, it's nice while it works. FOMO is fear of missing out. We saw that in the 1999 melt-up situation, is don't bother me with earnings. I just have to be in this internet concept. And this time around, the valuation multiples kind of stuck around 20. That's not low, but it's not terribly high as long as the economy is growing. But it's earnings that have really been phenomenal. And some of that has been mark-to-market capital gains on SpaceX for Alphabet and Amazon. But take that out, and you basically have 25% increase in earnings in the second quarter, and about the same in the third and fourth quarters. So yeah, I've been bullish on earnings, but not bullish enough.
That seems to be...
You said I'm not really the bull on Wall Street. It's all these analysts who talk to companies, and the companies are bullish.
So the companies are the big bulls on Wall Street, not Ed Yardeni. I am curious, though, about what we have seen with performance of the equal weight versus the market cap weight. And that has been a shift this year versus previous years, where the outperformance has come from the broader market. We were talking before about how the market seemed to be outperforming the economy for a number of years. Is that shifting? Or now we're going to see the economy, the rest of the economy, outperform the market?
Well, there's sort of a view that the stock market is not the economy, but it is, because it's PE times E, and E is earnings, and earnings are driven by the economy. And so I think the resilience of the economy, the strength of the economy has been demonstrated in the earnings, and the earnings are driving the stock market higher. So with regards to your point on, I call them the impressive 493. You know, you have the Magnificent Seven that did very well for quite some time, and now they've actually, so far this year, significantly outperformed the impressive 493. And I think it's because people have AI fatigue. It's like, oh God, I can't really figure this out anymore. You know, these stocks go up 20 bucks, down 20 bucks. And so I think people are just kind of taking an index approach to AI, not knowing exactly which stock to buy. And meanwhile, they say, well, who's the sure beneficiaries? And I think they're finding lots of ideas in financials and healthcare and industrials that are very, you know, we understand their businesses, and we also know that there's a good chance that AI could help.
When you talk about going up $20, going down $20, this is exhausting, this sort of single name volatility. Is that part of a problem with respect to the amount of leverage that's being used in specific sectors and specific funds? And I'm wondering, even just with the debt profile and the investment that's going on, a lot of this is coming with leverage. Does that worry you?
Not terribly, in the sense that this is not a new development. We've always worried about margin debt. We're always worrying about credit, and rightly so, because the credit markets tend to see problems before the stock market, and we saw that certainly in 2007, 2008. So the debt is always an issue. Especially if it goes bad and you have a lot of defaults, and then you get a credit crunch, and then you get a recession. I don't think that the problems in the debt markets, we're seeing the hyperscalers bond yields of the spreads over treasuries have widened a bit, but they're still able to raise money. And now NVIDIA came up with this idea that let's call in all these top financial people from the Hamptons, put them in the Hamptons jitney, bring them in, and to talk about $500 billion of financing. So, you know, NVIDIA basically said, okay, you're worrying about financing? Watch what we have to say about how we're going to do $500 billion. I don't know, it was a little hype. I mean, it was, you know, it was all done with a memorandum of understanding, and we know how well those things are going these days.
I love that you think they came in via the jitney, but what's funny about this is that if you think that is hype, And that's basically just NVIDIA trying to basically quell some of the concerns out there in the market. Yeah, then does that make you a little bit nervous, actually?
Well, I think that AI is a fundamentally important technology. It's not a revolution. It's actually an evolution of the digital revolution that started in the mid-1960s with IBM mainframes. And the whole point of the digital revolution is to process as much information as we possibly can, as fast as we can, as cheaply as we can. AI is just the latest progression of that. Next will be quantum computing mixed in with AI. And there's a lot of positives in all that. There's negatives. Some companies will flourish. I mean, for a while there, people thought, cybersecurity is software. Let's get out of the software. Let's get out of cybersecurity. And then all of a sudden, they come right back in, realizing that as AI gets "quote unquote" smarter and smarter, we're going to need more and more cybersecurity protection.
You say in your note that you've been bullish on earnings, but not nearly as bullish as the recent consensus of industry analysis, and that's what you said to us as well this morning. So, is your price target even high enough for you? Do you think you're going to have to come back and reprice?
It's possible. I mean, look, I was thinking that the market would be discounting $375 a share at the end of this year for next year. Now I've raised that to $415 a share for next year. So by the end of the year, if the analysts are still talking about something like 415 for next year, and they're already talking about 408, so we're getting there. 415 times a little bit over 20, and you get my new target of 8,400. Now I did keep my 10,000 for the end of what I call the roaring 2020s. By the end of 2029, even I get kind of confused about the decades here. But we're in the 2020s. It's gone well, and I think by the end of the decade we should be looking at 10,000. I'm not raising that, but I might.
How much is inflation a constraint? And by inflation, I don't just mean the CPI print that we get in about an hour and a half, but also what that does to bonds, given all of the spending globally.
Well, look, the CPI is widely expected to be, on a core basis, up 2.5% year over year. It's important to realize that the consumption deflator, which the Fed tends to watch more closely, according to the Cleveland Fed's now inflation forecasting, that's expected to run like 3.3%. So the Fed chair, Kevin Warsh, came in June said, I am committed to price stability. We've had inflation too high for too long, over 5 years. In July, he said it again, and the bond market seemed not particularly satisfied with that, because it's like, what are you waiting for? So maybe he's waiting for the CPI, maybe he's waiting for, as you said, there's a lot of data that's going to come out.
Yeah, I am curious, though, about the bond vigilantes, which you coined. Are they back when it comes to the 30-year note?
In Japan.
Well, they're coming back globally, given the fact
they're coming back globally to a certain extent. I don't really get freaked out by bond yields between 4 and 5%. The 10-year between 4 and 5% in the U.S. And the reason for that is, people keep talking about higher for longer, implying that the rates should go down at some point, that they're too high. This is normal. 4 to 5% is where we were before the great financial crisis. It's where we were before the inflation of the 1970s. I think it's a testament to the fact that the economy is doing well, and 4 to 5% is an indication of that.